The majority of crypto traders are overexposed to digital assets and lack balance in their portfolios. In situations such as these, failure to plan is a plan for failure. The crypto market has extremely low barriers to entry, meaning anyone with an internet connection, a smartphone or a computer, and a bit of starting capital can theoretically become a trader. Sadly, most of these beginners learn hard lessons and go broke. Here are 10 common mistakes made by beginning traders that you should avoid at all costs. 1. Starting with real money rather than paper trading. There is no reason for a beginning trader to use real money when there are endless resources and platforms for paper trading, including TradingView. Anyone interested in becoming a professional trader should first develop a system based on a simple set of guidelines for their entries, exits, and risk management. This should not be done with actual money. Paper trade until you are ready to lose your mind, then paper trade some more. 2. Trading without a stop loss. Beginning traders tend to trade emotionally, which manifests in refusing to quickly accept losses. The most essential skill that a trader must possess is the ability to accept a loss and move on to the next trade. Failure to do this is the main reason traders lose money. Set a stop loss and do not move it when the trade goes against you, as this behavior is likely to blow up your account. 3. Failing to maintain balance. Successful traders maintain a balanced portfolio. Personally, I only have 10% of my wealth in crypto. Within my crypto portfolio, 70% is long-term holds, heavily weighted to Bitcoin, with 15% in cash and 15% for trading. I only trade with 15% of my portfolio, and that portfolio as a whole is only 10% of my net worth. Rebalancing is the process of returning your portfolio to its target asset allocation as outlined in your investment plan. Rebalancing is difficult because it may force you to sell the asset class that is performing well and buy more of your worst performing asset class. This contrarian action is very difficult for many novice investors. 4. Adding to a losing trade. Investing and trading are different. Investors average down positions in fundamentally sound assets with a long time horizon. Traders have defined levels of risk and invalidation for their trades. When their stop loss hits, the trade has been invalidated and they should move on to another asset. Period. Never average down as a trader. 5. Failing to keep a trading journal. Successful traders have a plan. Part of trading with a plan is holding oneself accountable for your actions. The only way to do this is by recording the details of a trade. This is the best way to learn and avoid repeating trading mistakes. Keep a journal and refer back to it. Record your thought process, emotional state, and the trade results. It will help you immensely. 6. Risking more than they can afford to lose. In crypto, people are drawn to the idea of earning life-changing money by being in the right place at the right time. As a result, they go all in on crypto, risking everything on what is effectively a lottery ticket. 7. Being undercapitalized. As the saying goes, it takes money to make money. Many beginning traders are blinded by the promise of making boatloads of cash without leaving the comfort of their couch. This is a false reality unless they already have significant capital to trade with. A trader who wants to be a professional needs to be able to support their entire life with trading. That means their profit must cover their living expenses without eating into their trading capital. In most parts of the world, this requires at least $50,000, $100,000 to trade with, and a steady profit of 10% monthly. In reality, this is very difficult to achieve. As a result, many beginning traders find themselves under a great deal of stress when their expected trading returns fail to align with the actual results they produce. 8. Using leverage. Don't do it. According to a well-known investment cliche, leverage is a double-edged sword because it can boost returns for profitable trades and exacerbate losses on losing trades. Leverage should only be used by advanced traders who have been profitable consistently for years. There is no surer way to lose money quickly than to use leverage to rapidly compound your losses. 9. Acting on trading patterns and indicators that are not clearly understood. Beginning traders are terrible at technical analysis. They often identify patterns on a chart that are not there or are incorrect based on context and chart placement. Beginning traders should develop a very simple system for trading and avoid making decisions on patterns or indicators that they do not fully understand. Start with simple support and resistance or indicators that are clear like exponential moving averages. 10. Following the herd. Another common mistake made by new traders is that they blindly follow the herd. As such, they may either end up paying too much or FOMOing into a hot coin. Experienced traders are accustomed to exiting trades when they get too crowded. New traders, however, may stay in a trade long after the smart money has moved out of it. Novice traders may also lack the confidence to be contrarian when required. As previously discussed, most cryptocurrency traders are blindly following calls by strangers on Twitter. There is no surer path to financial ruin than spending your hard-earned dollars on assets who are likely manipulating you for their own profit. 11. Not using stop-loss, risk management. Stop losses are the holy grail of risk management. Stop loss helps you to minimize the losses when your anticipated trade goes south. It does not matter how confident you are about a trade going right. Not using a stop loss is the biggest egoistic mistake you could ever make. Almost all the best crypto exchanges offer this feature to set a stop loss, of which some offer a trailing stop loss feature. I will cover stop loss and trailing stop loss in the days to come. You must start adding it. Using stop loss with every trade you make helps you avoid the #1 mistake crypto traders make. 12. Not doing fundamental analysis. A lot of beginners start by picking a popular cryptocurrency and start trading in them. There are chances that you will end up making good money for a prolonged time. However, when one fine day the coin dumps like there is no tomorrow, a single big loss would turn your portfolio red for a long period. The way to avoid this newbie crypto trading mistake is by carrying out a fundamental analysis of the coin that you wish to trade. 13. No trading plan. You must have a plan before getting into any trade. It means that you need to know your entry and exit plan, principal investment amount, and the maximum loss you are willing to take. Beginner traders usually don't have a trading plan, and they are staying in a loss-making trade for a long time. Having a trading plan before execution will save you from making novice trader mistakes. 14. Using margin trading too soon. Margin trading is borrowing money that you don't own from exchange to get into the trade. The benefit is that you will end up making a big profit with the same money. However, you can also face big losses if your trade goes south. Unless you have perfected your spot trading or paper trading, do not get into margin trading. 15. Trading multiple pairs. Trading multiple pairs initially will only leave you confused, hampering your skill development process. My mentor taught me to stick with one pair for the initial 100 trades. Even when I started winning after my 40th trade, he made me stick to the course until my 100th. I could only see the wisdom in his teaching with time. Staying with a single pair for the initial 100 trades helped me improve my skills about the rest of the stuff. Trading is a marathon, not a sprint. You are better off honing your skills rather than trading like there is no tomorrow. Trading is hard. However, if you are properly capitalized and take the basic steps required to learn trading and risk management, one can succeed and become profitable. The key is to have a plan. And no matter what happens, stick to that plan.